Hey, good morning, options traders, and happy Friday once again to everyone. And I had a trader recently ask an interesting question, and that is, can short puts be used as a substitute for long calls, or even for long shares of stock for that matter? And his question revolved around the fact that the short puts and the long calls have positive delta. And so I thought it would be helpful for the rest of the group to share my answer, because you have to be very careful whenever you're setting up your strategies based on your outlook, but you also can't just look at things in one dimension. You can't just look at delta. You can't just look at gamma. You have to look at how all of the pieces of the puzzle work together, and probably more importantly, how they are going to change as time and volatility and the stock price change. So what's the scoop here? Can short puts be used as a substitute for long calls? Well, let's start with the basics. Long calls versus short puts. Yes, it's true that long calls have positive delta. So does long shares of stock. And it's true that short puts have positive delta. But again, this is where a lot of traders stop and they say, well, they both have positive delta, therefore they're both the same. And so that brings up the question again, can you use these short puts as a long stock substitute or as a substitute, a proxy for long calls, just because they have positive delta? Well, we also have to dig deeper, and you have to realize that long calls have positive gamma. Actually, all long options do. Long calls and puts have positive gamma. So any option you buy, you will have positive gamma. That's important. And therefore, any option that you sell will have negative gamma. So if you short puts, you have negative gamma. So as I've talked about in videos in here on gamma, remember that negative gamma means that the stock price movement makes the position work against you. And that doesn't necessarily mean it's bad. It depends on what you're trying to do. But in a case like this, it's probably not going to be in your best interest. So let's take a look at it graphically, and it will help you to see the difference. So here is a long call in blue, and we have a short put in red. I'm assuming that the stock is currently at 100 right here in the center. So I'm going to use an in-the-money call, let's say an 80 strike call. So we see our bend here in blue at 80. And I'm going to compare it to a short put with a 120 strike. So we see the bend at the red line here lines up right at 120. So the call's 20 points in the money and the short put is 20 points in the money. So the stock again is right here in the center. So yes, you can see that the straight line right here in red and in blue are virtually identical. They both lean in the same direction. They're both virtually delta 1, but it's only for a range. Remember that up into here, we're going to see that things are going to change. Why? As you get closer to the strike, that's where the optionality kicks in. And depending on whether it's long or short is going to greatly affect the position. So as I've shown in other videos, remember that all profit and loss diagrams really have two curves. There's the current curve, which we're looking at here in red and blue, but there's also a current curve. So if you look at just the call option, the current curve might look like this. And as we get closer to expiration, it's going to shrink right down onto the blue. If we look at the short put, it will have a current curve like this as well. And as we get closer to expiration, that skinnier curve right there is going to move up towards this darker red one. That's your positive theta. So now to make it a little bit easier to see what's happening, let's just look at the current curves. We're going to overlay the blue with the red. So again, if the stock is near 100, and as you can see, if it rises a little bit, maybe up to 110 or 115, or maybe if it falls a little bit down to 85, maybe down to 80, yes, both positions will behave reasonably close to each other. But look what happens if the stock continues higher. So if your position or your outlook is that you're bullish and you short these puts, if that stock really makes a bullish run, look what happens. See, these short puts start to flatten out. That's your negative gamma. Remember I said that negative gamma means the position is working against you. So yes, you've got positive deltas, but only for a while. And then that negative gamma is going to start selling off those deltas. And that's why this red line will eventually go just dead flat out here, which means you're not participating anymore. But look at the blue line. It never leaves that delta 1 position. Let's look at the downside. If you're wrong and the stock falls, the blue line with the long call actually starts to help you. This is the positive gamma coming to your rescue. This is the insurance value of that long call starting to slow down the rate of those losses. And that's why the blue line starts to flatten out on the left side of the chart. But look what happens to your short puts. They remain delta 1 all the way down to a stock price of 0. So you have to be careful. There are certainly times that you might want to use a short put over a long call as a substitute for long stock or for a positive delta position. But most of the time that's not going to work for you. I would usually suggest traders take a deep in the money call if you're trying to make it behave like shares of stock, mostly for these reasons. Now, what are some possibilities? Well, for those of you who trade the VIX, Volatility Index, remember that the VIX extrinsic value depends on the futures contracts. I've talked about that many times. It does not depend on the actual index. All right, so if that's true, you might see that the index is at a certain level, and it might appear that your call option is missing 5 or 10 or 15 points of intrinsic value, and that's simply not true. It's based on the futures contract. So that can cause some problems. You've got all of these volatility variables going on. You've got the fact that you're dealing with different expirations for the futures contracts, and that can really throw a wrench into the works if you're trying to place a bullish position on the VIX. So if your outlook is for the VIX to rise, just that you're bullish, in a case like that, short puts might actually be a better substitute because there will be little extrinsic value that you have to deal with. In this way, if you are correct that the index rises, it will absolutely deplete that intrinsic value. So again, those are some possibilities, also for the fact that usually the VIX is fairly low, maybe around 20 or 25. So there's only so far that it can fall. It's a lot different from shorting a put on Amazon when it's trading at $3,300. So as I mentioned, there are some cases where shorting a put might actually be a better choice. But for the most part, if you're going to make a better decision, you need to consider gamma, not just the delta. So I hope this helps you to break that tie for anybody who's ever wondered if you can use a short put as a substitute for a long call or even the underlying stock. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.